If I wanted to raise $100 million for my company, this is exactly what I would do. In this video, I'm going to walk you through the 3 steps I'd personally follow if I were raising serious institutional capital. 20 million, 100 million, 500 million or more for a high growth company. I spent years helping raise capital for low to mid market across industries ranging from oil and gas, renewable energy, fintech, tech, healthcare, and industries you've probably never even heard of. This is the framework that me and my team have refined through hundreds of real deals, thousands of investor interactions, and some of the most high-stakes negotiations you'll ever face in private capital markets. The most overlooked stage of any successful raise, you guessed it, the foundation. Most founders want to jump into investor meetings. That's a bad idea. You're not ready. In fact, I'm willing to bet 80% of the 12 phone calls I take every single day, they're not ready. So let me show you how to prep like a pro. So what type of round are you raising? Is it seed? Is it Series A? Is it strategic growth? Are you solving for runway, strategic support, valuation uplift, or all 3? Avoid raising for vague reasons. That will kill your deal before you even start. So perfect example, we had a CEO who said, we need to raise $100 million to dominate our market. Okay, well, that's not an objective, that's a dream. And after deep analysis, here's what we found. There's $40 million to acquire 3 strategic competitors before they got funding, $25 million for international expansion into untapped European markets, $20 million to build AI infrastructure that would create a 3-year competitive moat, and then $15 million of working capital to fulfill signed enterprise contracts worth $300 million. It's the same $100 million, but now we had a story that the investors could lean into. Now we have urgency. Now we had a plan that sophisticated investors could evaluate, get excited about, and actually fund. Have you hit the traction milestones for your round size? Is your cap table clean? Are you investor ready on unit economics, on bookkeeping, on legal structure? For a $100 million raise, institutional investors expect $50 million ARR with 120% plus net revenue retention, a clear path to $500 million and beyond revenue within 4 to 5 years, proven unit economics that scale profitably, management team that scaled companies through hypergrowth previously, total addressable market, we call it the TAM, of $10 billion or more. I mean, we've turned away deals, $500 million deals because of red flags at this stage. And founders often skip these and absolutely pay for it in term sheets and delays later on. So don't miss this. Can you say what you do in 10 words or less? Can you answer why now with clarity? Do you sound like you belong in a boardroom with $100 million decision makers? If investors cannot grasp your model in 30 seconds or less, you're out, no matter how genius your tech is. You always want to start with warm capital. So friends, advisors, early believers, target 10 to 15 warm intros before any cold outreach. Build your capital stack strategy, angel, then strategic, then venture, then institutional, then family office. So you want to start small. You want to start smart. And remember, raising capital is all about momentum and not perfection. You're never going to be perfect. Just get things going. Okay, once your foundation is solid, it's time to get strategic. This is where most deals either stall or they skyrocket. So remember, you want to filter by check size, by industry, by fund cycle, and stage preference. Watch how they've behaved in similar deals. Use co-investment mapping to group targets by shared behavior. We had a fintech client trying to raise $100 million. They were pitching traditional SaaS investors who typically write $10 to $20 million checks. Wrong audience. We mapped the fintech growth ecosystem, 12 specialized fintech growth funds with $100 million check capacity, 8 strategic corporate investors actively doing $50 million or more deals, 15 family offices with fintech portfolio concentration. We helped clients close in 60 days just by reverse engineering fund behavior. This is what you want to do. Don't chase the VCs. You want to curate them. Try different emphasis. So team, maybe TAM, traction. Vary the pitch decks. 3-minute teaser versus a 10-minute walkthrough. Use pattern interruption in outreach emails. Don't sound like everybody else. As you recall in some of my previous videos, we talk about contrarian thinking. Don't be that person. Don't be avoid the 99% that these investors hear all the time. That gets boring. Now, one client doubled investor meetings just by changing the subject line from investment opportunity to we solve the wastewater problem for oil and gas that investors care about. Simple. For $100 million raises, your outreach needs to demonstrate you understand institutional level decision making. So I want you to track response rates, first to second meeting conversion, term sheet timing, objections raised. Track all the recurring ones. So here's what you could expect for a $100 million raise or more. Expect 6, 9, maybe 12-month process timeline, depending on the nuance of the raise. 40+ investor meetings, 15 to 20 serious prospects, 8 to 12 due diligence processes, 3 to 5 term sheets to create competitive tension, because what gets measured gets funded. Think of this like a B2B sales funnel with $100 million on the line. By the way, if you're mapping out your investor funnel and trying to keep track of all the conversations, the stages, and the follow-ups, you'll love the free template that me and my team made. It's our investor CRM sheet, the exact format I give to our $100 million clients and above to manage their outreach. You can download it below. Of course, you're welcome. Just hit the link in the description below, and trust me, it'll save you months and months of absolute chaos. All right, so this is where things go pro. If you're looking to raise 20, 100, 500 million, you don't win by grinding, you win by systemizing. Tools like Founder Suite, Airtable, Affinity, or even Notion or Google Sheets, if structured well, works. You want to track intros, follow-ups, meeting notes, stages and pipelines, objections. We're talking about investor name, firm name, type of investor they are, check size, warm or cold intro source, status, when do you contact them, what are the notes on these guys, is it a stage fit for them, is it a sector fit, is it a geographical fit, and then the follow-up action. This is what you want to use to navigate your investors and set up automated reminders for next touch points. I mean, for a $100 million raise, you need institutional grade systems. You need advanced CRM with deal pipeline tracking. You need secure data room with 100+ documents in it. You need financial modeling, please, with multiple scenario planning. You need legal document management system. And as I always say, you need weekly investor communication workflows. You're going to control the investor narrative. Remember, we talk about this a lot in my videos. You want to weekly update emails to all prospects, traction, hires, revenues, media. Frame every round like it's competitive, even if it's not. You want to push rolling closes to incentivize fast decisions, because momentum here is everything. Most term sheets land after investor update number 2 or even number 3. It's not the first meeting. So this is a critical point. At this level, you're managing 15 to 20 sophisticated investor groups simultaneously. Each has different decision timelines, 4 to 12 weeks, due diligence requirements, internal approval processes, risk tolerance, and return expectations. There's a lot going on. Case in point, keep track of it all. Okay, leverage term sheets against each other for better terms. Understand non-valuation levers, board seats, liquidation prefs, anti-dilution. Know when to walk away. Investors can smell desperation a mile away. I mean, we helped one founder increase post-money valuation by $30 million just by delaying 48 hours and showing another LOI. So let me break down what happened. It's important you understand this. We had 3 $100 million term sheets on the table. The founder obviously wanted to accept the highest valuation offer immediately. We said, hang on. Just wait. We use competitive tension to go back to this strategic and say, look, we love your industry expertise, but we need you to match this valuation to make the numbers work. The result, they increased their offer by $30 million to win the deal. So you could learn the game or bring someone in who knows the game. If you can get interviewed on industry podcasts, fantastic. Media, fantastic. You want to post investor-friendly LinkedIn updates. You want to build brand equity in the investor community. Always be doing something. Momentum, as we talked about earlier. When you're raising $100 million or more, the investors are betting on you as much as the business. So they need to see industry thought leadership, media recognition, peer respect from other successful CEOs, board level relationships. You got to think like a fund. You're running a process. The goal isn't just funding, it's creating leverage, compounding that trust, and setting up the next round before this one's even closed. We always call it at my firm the what's next round. Why? Because there's always a what's next. It's $100 million today, $500 million in 24 months from now. You better be ready. At $100 million, you're not just raising money, you're choosing long-term partners who are going to influence your company for the next 5 to 7 years. So every decision impacts your path to IPO or strategic exit. Choose wisely. Now, here's the reality check. Should you tackle a $100 million raise yourself? Most $100 million raises require professional help, and here's why. The institutional investor universe is completely different from that of friends and family. You're not dealing with VCs that you could just Google. You need private relationships with family offices, connections to sovereign wealth funds, strategic introductions to corporate development teams, access to private equity growth partners. The legal complexity alone is institutional level headaches. Term sheets for $100 million deals are 40+ pages with provisions most founders have never seen before. I mean, the opportunity cost is massive. A $100 million raise is going to consume 60% of your time for 6 to 9, maybe 12 months. You got to ask yourself, can your business afford that distraction with you handling everything yourself? If you're raising $100 million, you are betting the company. The difference between a great outcome and a disaster isn't the money. It's valuation optimization. We've seen $20 to $50 million swings, term negotiation that protects founder control, investor selection that adds strategic value, process management that minimizes business disruption. Now, professional fees on a $100 million raise typically run anywhere between 3 to 7% on the total amount, but consider if we improve your valuation by just 10%, that's $10 million in reduced dilution. If we accelerate your process by just 3 months, that's a quarter of resumed business focus for you. If we help you choose the right investors, that's years of strategic value. The question here isn't whether you can afford professional help, it's whether you can afford not to have it. Now, something I touched on earlier is pitch deck, and pitch deck's crucial. And let me tell you, I've seen way too many founders absolutely sabotage great raises because their pitch deck sucks. It's confusing. They put their engineers on it, and no one could read it past the 5th grade level. Sometimes it's just flat and boring. And that's why I made this video right here, where I break down the most critical pitch deck mistakes that I see over and over and over again, and of course, how to fix them. So if you're serious about raising capital, this is something you cannot afford to miss. So I will see you over there.